Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking about the attractions of private credit as an alternative investment that appears to be going more mainstream. And my guest is Shana Sissel, founder and CEO of Banrion Capital Management. If it's been chilly for investors over recent years, one hotspot has been private credit, a market that from around $500 billion of assets under management in 2015 has grown, it's estimated, to around 1.4 trillion now, and which could add another trillion or so to that over the next 4 to 5 years. And the turmoil in US regional banks has given it a new edge. As they tighten lending, it means new opportunities for private credit firms, though also more competition for top quality deals. So is this a good time to boost your portfolio with private credit? Well, with me to help answer that and other questions is Shana Sissel, founder and CEO of Banrion Capital Management. Welcome to Sectors Up Close, Shana. So is this an auspicious moment for investors looking at this sector?
I believe so. If you think about the great financial crisis, we saw a huge demand for alternative types of credit at the time as banking loans became harder to get. And we saw a boom there. A lot of the crowdfunding, crowdsourced lending, those kind of things came out of that crisis. We are at another point in time where we are seeing stress in the banking system and difficulty in the lending markets, which again opens the door up for the private credit markets. So absolutely a good time to be in the space.
Well, let's talk about some of the more eye-catching areas of activity. Emerging markets and infrastructure did very well last year. Is that the sort of area where you think there is value?
I do. I think that you'll see a broadening of opportunities. But remember, private credit oftentimes is higher up on the capital structure than traditional public fixed income. So it's going to be more common in areas where there is some sort of physical collateral. So industrial makes a lot of sense there. Infrastructure makes a lot of sense there. Maybe somewhere in the healthcare space could be very interesting as well. But that is really the focus of these types of lending products, is to have some sort of backed collateral that is the focus of how they evaluate these deals.
So commercial real estate has been traditionally attractive for private lenders, but there are warnings out there that it could be the next big hole in bank balance sheets. Is that an opportunity for private credit, or is that a red flag over that sector?
There are certainly some areas that I would not want to be lending to. There are certainly areas I would not want to be investing in. But places like warehousing, logistics, anything related to the supply chain, anything related to getting goods from one place to another, especially that last mile, are attractive areas to be investing in right now.
And what about the broader macro backdrop? Could private credit markets face a reality check as higher rates and a squeeze on corporate earnings, they undermine the ability of borrowers to pay their borrowing costs?
Well, keep in mind, the reason the private credit markets tend to do well at these types of inflection points in the market is actually because they are the only area that borrowers can really go to if they have a need. Yes, it is going to be more expensive. That's the nature of where you go when you're not the bank.
And one factor, of course, in the surge in private credit was the low yield environment of a few years ago. That, of course, has been turned on its head. So where does that leave private credit in the future?
Private credit very much tends to play in the floating rate area. So they tend not to have set rates. They tend to always be more floating rate. So if rates continue to stay stable and potentially have more chance of it rising more rather than going lower, and I would argue that that is the case, these are the types of products that will actually do quite well because they can take advantage of that.
This is a sector that is a little bit opaque and arcane for mainstream investors, and detractors point to some negatives around a lack of regulation, for example, competition for investments leading to lower quality deals, difficulty in liquidating investments. What do you say about those negatives?
So from a due diligence perspective, it's a little more onerous, and you do need to consider that. I often say that this isn't necessarily a market for somebody not working with a professional. Professionals really need to be involved here because of the increased due diligence that's required. And I often also say that depending on what kind of investor you are, you want to have some skepticism, because if a deal is being offered to a broad base of investors, I mean, outside of the institutional realm, the broader the base of investors is being offered to, the higher the likelihood of the quality of the underlying debt is not that good.
OK, Shana, we'll leave it there. Shana Sissel, founder and CEO of Banrion Capital Management. Thank you for sharing your insights today. And that is your roundup of private credit. I'm David Pollard, and this is Reuters.